Charlie, is this one we need to worry about? There was a time when Cisco was a bellwether for the whole tech sector because of the kind of equipment that people were buying for their data centers. Not as much anymore, but that idea of a demand slowdown for some of this hardware, or maybe there's just a unique stockpiling, inventory issue for networking equipment writ large. But how do we take this? I know you tend to look at value stocks. Maybe not a name like Cisco, but is this a warning of any sort, or maybe just an individual case?
Yeah, Cisco is actually more reasonably priced than some others. We are seeing actually across the board this issue with enterprise tech spending, and the fact that because people couldn't get the parts they needed, the systems that they needed, they pre-ordered, and because of the supply chain problems that we had when the supply chain got fixed in this space, too much product got sold into the market and into the channel. And we are seeing the ramifications of that with a couple of other names. So this is not surprising. It's probably bigger of a miss than we would have expected, but we are seeing this in other companies.
Yeah, I want to well, first of all, don't miss Jim Cramer's exclusive interview with Cisco's CEO. That's going to be coming up at 6 p.m. Eastern on Mad Money. So we'll get some more details there. But in the meantime, Barbara, I want to get your thoughts on this name, too, because the commentary about the second half of the fiscal year and seeing a rebound there, I thought was interesting.
Yeah, that is interesting, because I think one of the concerns coming in was that it would be second half slowdown was likely. And certainly the company had been talking about that. So that's a very interesting reversal. But there was also, I think, an expectation that the backlog would be largely worked down, by the end of this quarter. And that seems not to be happening. It's going much slower, because that's the question. What are the new orders? Yes, revenues the last quarter were up significantly, but orders were down 14%. And it looks like all that is being pushed out. So I think the comment, so it looks like it's not even so much a slowdown. We do know there's a slowdown in enterprise IT spending. We want to hear their commentary on that. But it really looks like it's taking them a while to work down the backlog of orders. But it's encouraging about the second half. So it'd be very interesting to hear what he has to say to Jim later.
Okay, that's taking a big dive. We're still waiting on Palo Alto. Charlie, while we wait, I want to get your take on some individual names that you've mentioned that you're watching that are very much not tech. Mohawk's one of them?
Mohawk has had a nice recovery, John, since you and I talked last. This is in, obviously, carpets and surfaces, and it was really hit hard by the 8% mortgage rate that we talked about. And the stock got down to less than 10 times earnings, which its average has been more like 15 over the last 20 years. Became just a very much of a cheap value stock. And it's had a very nice rally here the last week and a half, still way below its historic average, trading for less than 6 times EBITDA. So still a long way to go. But again, if we can get away from that Fed headwind of people thinking the Fed's going to bring in a Fed-induced recession next year, then Mohawk still has a long way to go.
Yeah. Barbara, I want to get your thoughts on what we've seen so far from retail earnings and all of these consumer-facing companies this week, because it has been such a big week for those types of readings. And as we go into the holidays, I can't believe it, we're just over a week away here, what it signals not only about the end of this year, but as we look to 2024, as we do see signs of slowing down, even if not recession.
Well, I think you're hearing a common refrain, and you heard it certainly this morning from Target in terms of what they're seeing with the consumers. There's more sticking to, essential goods, whether it's food and beverage and other purchases delaying until the last minute. So you are seeing some pressure on consumer spending, even though we know there's still, pretty full employment, 3.9%. It's crept up this year. Wages, are still good, but you're seeing some pressure in terms of higher credit card usage, and increasing delinquency, still not at the danger point, but the trend is definitely showing a consumer that's weakening. Even the initial jobs claims, by the way, tomorrow will be very interesting, because that is a leading indicator. And so far, that has been below historical averages. But if you look at the running claims, for continuing claims, it's up 7 weeks in a row. So I think we're getting the message from retail and from stats like that the consumer is weakening. And it's, again, not yet a crisis, but we'll see. Even the savings rate, and the savings rate is not what your securities or your house is worth, but it's really the difference between your disposable income and your expenditures has decreased from 5.4 in May to 3.4% in September. So lots of stress is showing on the consumer, but still spending.